The question we're going to answer here is, what is fair value for the S&P 500? At least our chief equity strategist and economist, John Blank, will answer that. John, first off, what is fair value based on for those who don't know?
Good question, Terry. It's on the S&P 500 forward 12-month operating earnings. So it's not actually on an annual basis per se. For example, we are now on the 23rd of February, so we're basically 2 months in the year. So fair value would be the S&P 500 operating for all of the next 10 months of 2022 and the first 2 months of 2023, and a 5-year average price earnings ratio for the S&P 500 as our proxy for what it should trade at from a valuation perspective. So the answer is basically 18 on the latter, that's the 5-year average, basically around 18. And the former is around 220, 225. And the reason we always have to do these podcasts on fair value is every time you do a few months of time, both of these two factors, particularly operating earnings, change in a forward-looking context.
So just for clarity, given everything impacting stocks right now, are those two numbers that you just gave the current fair value?
Well, that's what's interesting, Terry. In January, we ended the year at 4,800, and I predicted at the end of the year that the fair value on that assessment that I told you about would be 4,350. And this morning on Wednesday, the February 23rd, we're trading around 4,320. So fair value is really accurate now, and it suggests that there was, a 10% Fed liquidity premium that has been dissipated from the market, and we're now trading at fair value, which is fascinating. And it also shows that fair value is not, if it's done in the way I do it, and by the way, I stayed with 4,350 for months in advance of 4,800 because that's what it was. And this is what it shows you, is that you really did want to sell, and I did sell in large cap trader in November, December on that 4,800 because that fair value was 10% below.
What do you see for the end of 2022?
Well, then again, the way we do this is this, 5-year average PE to 18, and then the 2023 full year EPS. And what you get there is about 4,900. So that is where actually Goldman retreated to about a week ago. And 4,900, like I said, if you're going to do this and just do it and not like have, genius, content to the whole process.
Yeah.
It's effective.
So can this fair value be computed for individual industries represented in the S&P 500 as well as the overall index?
It's a good point, Terry. You can and you could, but the problem there is, some industries, you got to define an industry by the stocks in it. And so that's kind of a problematic thing. And then you have to basically understand that some industries trade at much higher P's than others. For example, the infotech industry might trade at an 18 or 20 P, whereas the telco industry is, 9 or 10 or 12. So it's a more tricky thing to do, and you have to have a lot of experience with the stocks in that industry.
And how does it work for large cap versus small cap?
Well, the small cap one is usually the Russell 2000. So small caps, because they're smaller capitalization, you have 4 times as many stocks in the Russell 2000 you do as the S&P 500 because they're smaller. So you end up getting a much more granular perspective on fair value from a Russell than you do the S&P.
And what's the benefit to investors of knowing this fair value?
Well, again, the problem with fair value is you got to be disciplined in the manner you present your computations, and some people just, they do the genius factor and add something they want to put in there. But if you try to really understand it and watch it, it gives you a good sense for when you should be buying and selling. So right now we're, at least in the first buy node in a long time, and you probably should have unloaded stocks, a month or two ago.
Let's take a look at the bond markets. You wrote recently that risk-free bond markets everywhere appear to be nearly fully pricing in an oversized, that's 50 basis points, U.S. rate hike in March of this year, 2022. Is this good or bad for bond traders?
Yeah, well, first of all, since the Ukraine crisis, that bond pricing has fallen off dramatically, and now people are back to not thinking that's going to happen. So I put that out there. The other thing I would point out is basically everybody is pretty much believing that there's going to be these rate hikes anyways of whatever measure, and that bonds are going to get on the 10-year basically around 2.5, and that'll be the neutral, what's called the neutral rate eventually. So the idea here is that all rates on the short end will get to the long end to this neutral rate where the Fed feels they can just, steady state manage the economy. So that's basically 10 rate hikes. So that's what you want to keep in mind here with the bond market is when they're hiking for 10 cycles, typically they do that every other meeting. So you're looking at 20 to 24 months of rate hikes for the next 2 years. And that means you're basically stone cold stupid to buy bonds for 2 years.
Interesting. Well, for those who consider tech and growth stocks a buy right now, you've got three that might be worth considering: Airbnb, Xilinx, and ST Microelectronics.
I like Airbnb because it's a stock that you can play for the end of Omicron and the spread of travel. So Airbnb is a good stock there. Xilinx is, I think they've been bought, and there's some kind of arbitrage premium there. And STM is a great chip stock to play right now if you like the chips, and that's still a chip shortage area. So that's why I like STM.
Our chief equity strategist and economist, John Blank, looking at 2022 with some optimism. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.